I think we've seen, well, two things I would particularly pick out. The first one is that when we look at the labour market, we do see it softening. I go around the country and there's a lot of talk about lower employment. I think that's actually lower hiring. It's not so much people being made redundant. That it hasn't particularly picked up. But I think a lot of companies talk to me about reducing their hiring and their hiring intentions. So I think we are seeing some softening in the labour market. I think we're seeing a bit of that in the way pay measures, particularly in the private sector, are coming down now. They a little bit undershot in the 3 months since August where we thought they would be. So that's one set of things. And then on the inflation front, and obviously our job is to get inflation back to its 2% target. The first time, and the latest number we've had sort of a couple of weeks ago, we saw it just begin to undershoot where we thought it might go to. B, we thought this would be the peak around now. And I think there's a little bit more confidence that's the case, and it may have peaked at a little bit of a lower level. But we'll have to watch this very carefully.
So what more do you still need to see in the data then to warrant a rate cut? Because as we've mentioned, it has slowed since September, and you've said that the latest inflation print is promising, but it's just 1 month.
Yes.
But when you look at the constellation of data misses that we've had now, whether it's inflation, wages, undershooting activity, is that range of data enough to tell the story? Or
well, I think again, the constellation, as you say, is the one we will continue to, I think, look quite we will look intensively at. And I just come back to the point about the inflation number, because I think that's obviously important because it's our target, obviously. 1 month is obviously good news. And by the way, it was reasonably broadly based across the components of inflation, which is also important. We sometimes get months where it goes under, and the staff say to us, but there's one particularly erratic thing in there, so don't sort of count your chickens. It was more broadly based, but one number doesn't make it, as it were. I think we need to see that picture now sort of be more established. That's what I'll be looking for.
So how, in terms of a timeline of that?
Well, we'll see. I mean, as I said, I've said in the paragraph that I've written for the minutes this time in our New Style minutes, that I'll certainly be looking at the rest of this year, and the evidence we see between now and our last meeting, because we've got one more meeting this year. And we have got 2 rounds of the data in our meeting schedules mean that for the next meeting we'll have 2 rounds of data before we next take a decision, because that's the way the schedules fall.
And part of your thesis is based on inflation taking time to come down. So if you saw a shock in the near term that brings down inflation much more rapidly in the near term, so what would that change to the balance of risks in the medium term in your view?
Well, I mean, the first question we always have to ask then is, so what are the underlying causes of that shock? Is it something that fundamentally changes our position, our view of the sort of the balance of the economy? Occasionally you get quite erratic things going on and you think, well, that might not last. But so if it's a quite fundamental thing, then that will obviously be built into our picture.
What about the budget then, of course?
Well, so we know one thing with absolute certainty: there will be a budget delivered by the Chancellor on the 26th of November. So we will have that before we next meet and be able to incorporate that into our assessment.
But when you have these scenarios laid out in this the Bernanke review, how can you look at everything? I mean, do they extend to fiscal policy? And if not, then how can you look at everything and prejudge everything but not fiscal policy?
Well, we don't construct a scenario for everything. Partly because I think that would cause scenario overload, and partly because obviously some things move the picture and sort of change the picture more than others. And so what we've done is say, well, look, there are risks on both sides here. We can see that. There's a risk because of the environment, the background of what's happened in the past, that we get more persistent inflation. But there's a risk that the economy is softening more, and we constructed the scenarios this time to, in a sense, incorporate and develop those, particularly so, to be honest with you, so we can tell stories about them and to explain them, these risks more, I think, more clearly. And so that's what we'll do.
And you mentioned as well there the potential of AI on productivity, but also the risk of an AI bubble as we see these valuations getting high. If it burst, how would that change your assessment of financial conditions, and how much would do you see that spill over into the UK?
Well, first of all, I very strongly say it is quite compatible that AI, as I sort of think it probably will turn out to be the thing that moves the dial on productivity next in the economy. It's the next what we tend to call general purpose technology innovation, which are the things that over a long, long time in our economy and other economies have moved the dial on productivity. And that would be a very good thing, by the way. It is, of course, however, quite possible that we could have a bubble at the same time, because what the markets are having to do is value the future stream of earnings from this thing. That's uncertain. So we could still have a very positive productivity contribution, and the markets find that they've somewhat overdone it in terms of how big. We'll see. So we have to be very alert to these risks. You're right. I mean, it could change financial conditions, and again, we will have to factor that in both to our financial stability and our monetary policy assessment, which is what we'll do. And we are looking obviously very carefully at this question of market valuations.
And going back to rates, because Deputy Governor James Ramsden has said that the MPC as a whole viewed that the neutral rate was somewhere between the 2 to 4% range. So at 4%, we're at the upper end. If you cut again, will you still be able to say that rates are restrictive?
Well, I mean, 2 to 4 is of course quite a broad range. So it's a fairly broad church that we get into. I have to be honest. I'm the committee. There are sort of two schools on the thought on the committee on this question. There are some members of the committee who take the view that you can estimate what the neutral rate is, and that you can arrive at an estimate with obviously some band of uncertainty around it, but you can estimate it. There are others amongst us, I'm in this group, who say that is really pretty uncertain. So I mean, telling me it's between 2 and 4% doesn't provide me a tremendous amount of guidance, if we can say that. I mean, you'd have to be a bit more precise, I think, to use it. And it's just too uncertain. So what I tend to do, and I'm not alone in this on the committee, is to say at every point when we meet, we look at monetary conditions. We look at the way in which the transmission of monetary policy is working. What effect is it having on the economy? What effects, for instance, take mortgage rates, for instance. How are they passing through? What is the impact of this? And you can build a picture of sort of what we tend to call restrictiveness of policy. Now, I think we're past peak restrictiveness, which is, in a sense, you'd expect, given we've cut interest rates 5 times. For my part, I think policy is still restrictive, but it's past peak restriction. And there are quite long lags in some of these restriction measures. If you take, sort of, again, mortgages, because changes come through quite slowly.
And given you were the swing vote in the committee, did this decision weigh more heavily on you this time? Because it makes it especially important to think about your framework when you come to this decision. Can you give me a quick overview on that? And also, how much did it matter in your debate whether the fact that we're still going to get more data points in November and December as well?
Well, every decision is an enormously important one. I mean, every decision we take on the MPC, I mean, we're very, very cognizant that this affects, the economy, it affects people's lives. So, we take this with the utmost seriousness. I think the new arrangements we've published today and the new framework we've published, it hasn't really changed my way of thinking about it. But I think the good thing is that we've all had to set out. We will sort of write our essay, as it were, and set out how we think about it. I think that's a good thing, actually. I really welcome this, actually, that we've done this. Each of us has done this. And I think setting it out and writing it down and saying, this is how Now, by the way, I'm sure we'll all change and, develop over time, because the world changes around us. So please don't expect them to be constant in that sense, because I'm sure they won't be, actually. But I think it's a very good framework to operate in. I'm very, very excited about it.